I will just take a second to explain you all the purpose of this webinar. First of all, a very warm welcome to all of you in this webinar session. I will just explain to you the purpose of this webinar shortly. And after explaining the purpose of this webinar, we will formally start it. Okay. Okay, now let's formally start it. My name is Ahmed Shafi, and I have been teaching this financial management paper since the last 15 years. I belong to Pakistan. And together with this, I teach advanced financial management, P4, and performance management, F5, audit and assurance, F8. And many of my students have secured numerous nationwide, worldwide place winners in last many attempts, as you can see the results on your screen. Now, let's specifically focus this session on financial management, FM. Now, when people are giving financial management exam, every attempt, okay, it happens every attempt, okay, we are experienced players in this field, but obviously you are giving this exam for the first time, you are not that experienced. Whenever students are giving this exam, they always claim one thing, that we have no problems as far as section C of this particular section is concerned. Okay, we have no problems as far as section C of this particular Okay, let me first stop this chats from disturbing everyone. Okay, because if there is an internet problem at one end and someone forgets to open his voice, he starts disturbing everyone. Okay, I am not having any voice and everyone gets distracted. Okay, so let's just stop it. Okay, I was saying that whenever students are given this exam, there is always one claim that when we do the exam, when we do the past papers, we are not facing any problems in section C. Long questions, 20 marks, 2 questions. Always students claim this. And we do perform very well in that section. But we face difficulties in MCQs and MTQs, the section A, 15 MCQs, and the section B, 3 OTQs, we face problems in it. Now, if I tell you from your perspective, the problem is somewhat genuine because we have very limited MCQs getting published by the official examination team. Now, if you go to the ACCA website and try to find out practice past papers, you find very less MCQs and MTQs published there. Long questions, there are always published. So you are okay with that how our examination questions coming. But as far as MCQs, MTQs are concerned, they are not published so frequently. So you have very limited data as far as this MCQs and MTQs portion is concerned. Now, if you have very limited data as far as this MCQs and MCQs is concerned, what you do is you then rely on the revision kit. Okay, I will go to revision kit and I will solve the revision kit of Kaplan, or I will solve the revision kit of BPP, and then I will prepare for MCQs, MTQs. Now, if I talk about that MCQs, MTQs, obviously BPP, Kaplan do have some good MCQs and MTQs, but there are some MCQs and MTQs which are very far away from what is tested in the exam. So again, even after doing the kit, students somewhat feel uncomfortable or unprepared that no matter what will happen with MCQs and MTQs, and they start bothering by messages, what should we do, again, some panic attacks. Okay, Now, first of all, I would advise you to start accepting the challenge. Everything is not just a walk in the park that you go in a park, walk and enjoy and come back. This is the examination. Examination has challenges. And this is one challenge that MCQs and MTQs are not published. So no matter you study from me, no matter you study from any other tutor, you will have difficulties at the end in that, and you will feel underprepared, but that's perfectly normal. You are not the sole one who is facing this. Everyone is facing this around the globe. I teach in 80+ countries. Everyone has this issue. Okay, no matter he's our student or not. So don't just start thinking that, okay, I get prepared with MCQs like it's a walk in a park and I go and clear the exam. No exam has 100% pass rates. You have to face this challenge. So what we do is just a second, please. So obviously, now to overcome this problem, that what should we do? How can we help you in this? What we do is, I have prepared few MCQ classes. Okay. And those MCQ classes and MTQ classes, I conduct them 1 week before the exams, like I'm conducting here as well. Okay. Now, if you talk about these MCQ classes, I have already prepared 4 MCQ classes. Okay. Those students who have studied from me, they are on our LMS, Learning Management System portal. When you buy the course from us, you get these 4 MCQ classes. Okay. And 1 or 2 weeks before the exam, we publish it on our YouTube channel as well. My YouTube channel is on my name, Ahmed Shafi. Okay. You can search it, and there are 4 MCQ videos with the name of FM MCQ session part 1, FM MCQ session part 2, FM MCQ session part 3, FM MCQ session part 4. You can watch these 4 videos. Okay. And once you watch these 4 videos, you will have a sound understanding of MCQs. Okay. And this class which I am conducting today, this is FM MCQ session part 5. Okay. Now, these examination questions, MCQ questions, which are discussed in all those 4 parts and this one, they are extracted from examination MCQs. Okay. There are some examiner reports in which examiner publishes these MCQs. Okay. We extract them from here. And whenever I have told students to watch this MCQ session and go in the exam, remember, if you watch these 5 MCQ session videos, you might get few MCQs in your exam directly from these videos. You will see and you will give feedback to me after this class, after your exam. I'm sorry that, okay, I watched these 5 MCQ videos. This is the video number 5. And I did get few MCQs from this particular exam. Okay. Okay, so my advice is that take this class, and after this class, do go to the YouTube channel and watch those 4 videos with these names, and you will feel really comfortable with MCQs, and you will hopefully find some MCQs in the examination as well. Okay, so I am starting this session. Okay. Now, during the session, there is always a chance that there can be some disconnection and the connection may be lost. Okay. So once there is a connection loss, we won't be able to get back. So what we do is I will be preparing a WhatsApp group and I will be sharing with you the WhatsApp group link now. Okay. I would advise you to join the WhatsApp group because once this session is over, I will share the recording on that WhatsApp group. Plus the old 4 MCQ sessions, I will also share there, and I will also share the notes. And if there is any connection lost, we can get back on it. Okay. So please join that WhatsApp group. I'm just sharing the link in the chats. Okay, so the WhatsApp group link has been shared with all of you. I would advise you to please join it so that we can start. Chaudhry Raza, if you have any urgency, you can leave at per your time because I cannot commit what is the duration of this webinar. Thank you. I'm again sharing the WhatsApp group link. Please join it, because then I will share something even during the class, and you will say, I don't have it because I'm not in the group. So please join it initially. Okay, so come on, I think we should start now. Okay, now on your screens, you would be seeing some MCQs, and you will be seeing the questions. So I will share this file with you as well. Okay, but let's just start discussing them so that you get a sound idea of how things are moving in this particular direction. Okay, so let's just start doing. I will discuss few MCQs with you, and I will discuss one detailed MCQ with you of business valuation. Again, I'm telling you, these are examination questions, right? So make sure you don't take them easy, and you prepare them to the best of your understanding. And you also watch the videos which I have told you to watch previously, the 4 videos. Okay, so that you get a complete grip on all of these things. Okay, so let's just start it. Okay, example number 1, which is in front of your screens. I will firstly address that. In relation to the ROCE, return on capital employed appraisal method. Okay, in relation to ROCE, the return on capital employed method. You have all known what is the ROCE, return on capital employed method. So in relation to ROCE, return on capital employed method, which of the following statements is correct? ROCE leads to better decisions since it uses accounting profit rather than cash flows. So we all know that ROCE uses profits rather than cash flows. NPV technique uses cash flows. IRR technique, payback technique uses the cash flows, the figures of NPV cash flows. But ROAS uses profits, right? So ROAS leads to better investment decisions since it uses profits rather than cash flows. Investment projects with a ROAS greater than WACC should be accepted. Investment project with a ROAS less than current ROAS should be rejected. Okay. ROAS takes into account all years of operation of an investment project. Now, which of the following statements is correct? Now, in order to answer which of the following statements is correct, in order to answer which of the following statements is correct. Now, whenever question asks you that which of the following statements is correct, and you are talking about a theoretical question, you are talking about a theoretical question. Now, always remember, in order to answer a theoretical question, which of the following statements is correct, there are always two ways. There are always two ways. First way, just catch the correct statement. Just catch the correct statement and tick it. Just catch the correct statement and put a tick on it. That's the first way. Okay. There is another way. Remove the obviously wrong ones. Remove the obviously wrong ones, and this will help you to reach the correct answer. Okay. Whenever you are doing any MCQ with respect to theory, okay, you always have two options as far as the theoretical MCQ is concerned. First, put the tick directly on the correct option. Okay. And the second, remove the obviously wrong ones which you find obviously wrong, and in the end the remaining one would be the correct one. Okay, so we can do this in this theoretical MCQ. ROAS leads to better investment decisions since it uses accounting profit rather than cash flows. This statement is wrong. ROAS never leads to better decisions. The better decisions is those techniques which uses cash flows like NPV. You might have studied in your studies that those techniques which are based on cash flows are better. Those techniques which are based on cash flows are better. So ROAS technique is based on profits. It's not based on cash flow. ROAS technique is based on profits. It's not based on cash flow. So techniques which focus on cash flow are the better techniques like NPV. They lead to better decisions. So this statement is wrong that ROAS leads to better decisions since it uses profits. Using profit does not lead to better decision. Okay. Investment projects with a ROAS greater than WACC should be accepted. This is also wrong. This is not the decision rule of ROAS. In ROAS, decision rule is that you should compare ROAS with target ROAS, not with WACC. Investment projects with a ROAS less than current ROAS should be rejected. This is also wrong. ROAS does not compare itself in decision with current ROAS. It compares itself with target ROAS. This is also wrong. So the last statement is correct. ROAS takes into account all years. Okay, you can tick it. If you have any questions, you can ask. I've also shared this Word file on the WhatsApp group. Okay, so if you don't want to see it on the screen and you want to see it on the laptop, you can do that. Okay. Hamza, the problem is we don't compare ROAS with the WACC. We compare ROAS with the target ROAS. That's why it's wrong. Okay, now this was an easy MCQ. Let's move forward. Example 2. Now this is an easy MCQ. If people have gone through the text, it's a very easy formula and it's a new edition as well. Okay, but the problem is people don't go through the text and then they find some difficulties in the exam. So make sure you are just overviewing the text. Okay, and this is a new thing as well. Okay. A large listed company is due to issue a 90-day commercial paper with a nominal value of 10 million. Each paper will have a nominal value of 100,000. The annual required rate of return is 4%, assuming a 365-day year. Commercial paper is in that theoretical chapters of the financial management function or the economic and business environment. Okay. A large listed company is to issue a 90-day commercial paper with a nominal value of 10 million. Each paper will have a nominal value of 100,000. The annual required rate of return is 4%, assuming 365-day year. What is the issue price of each paper? Now, in the book, this is the new edition. There is a formula. Issue price of each commercial paper. Issue price of each commercial paper. In the book, there is a formula. Issue price of each commercial paper. Now, in order to get issue price of each commercial paper, in order to get issue price of each commercial paper, there is a formula. Nominal value of each paper upon 1 plus total interest earned. Those who have gone through the latest text, they would have found the new edition here. Those who have gone through the text, they would have found the formula in this new text of commercial paper. It's a new edition. But those who have not, I have written in front of you. If the question asks you issue price of each commercial paper, it's nominal value of each paper divided by 1 plus total interest earned. 1 plus total interest earned. Okay. Now, let's start it. Issue price of each paper. The question is, a large listed company is to issue a 90-day commercial paper with a nominal value of 10 million. Each paper will have a nominal value of 100,000. Required rate of return is 4%, assuming a 365-day year. What will be the issue price of each paper? I have told you, in order to find the issue price of each paper, nominal value of each paper over 1 plus total interest. Now, let's find the issue price of each paper. Nominal value of each paper. Now, what is the nominal value of each paper? If you can clearly see in the question, each paper will have a nominal value of 100,000. So nominal value of each paper is 100,000 over 1 plus total interest earned. Now, how do you get the total interest earned? How do you get the total interest earned? Now, what is the interest? Return interest is the same thing. It's 4%. Interest is 4%. Total interest earned. Interest is always earned on par value, nominal value. You know that, right? This is just 5 days before the exam. And you know that interest and dividend are always earned on par. So 4% of par value. Now you need total interest earned, not interest of one paper. You need total interest earned. So 4% of total nominal value, 10 million. 4% of total nominal value, 10%. So 4% of total nominal value, 10% is 0.4 million. But if you just leave it here, this is the interest of the whole year. 4% of 10 million. This is for the whole year. Will you get interest for whole year? No, it's just a 90-day paper. So you will only get interest for 90 days. So apportion it. 0.0986. So 1 plus total interest earned is 0.0986, and add 1.0986, 100,000 divided by 1.0986. This makes our answer as I'm sorry, I'm back. So let's just revisit it again. Okay, question number 2. A large listed company is due to issue a 90-day commercial paper with a nominal value of 10 million. Each paper will have a nominal value of 100,000. The annual required rate of return is 4%, assuming a 365-day year. What will be the issue price of each paper? Now, issue price of each paper. This is a new edition, as I told you just before. And the formula of issue price of each commercial paper is nominal value of each paper by 1 plus pro rata interest rate. Previously, I followed the copied the wrong formula from the text. Okay, so nominal value of each paper plus 1 plus pro rata interest rate. Okay, now if you want to find issue price of each paper, the formula is nominal value of each paper plus 1 plus pro rata interest rate. You know what is pro rata? I missed the pro rata term because I was copying from the book. Now pro rata means proportionate. Pro rata means proportionate. Okay, so issue price of each commercial paper is nominal value of each paper plus 1 plus over 1 plus pro rata interest rate. Nominal value of each paper is 100,000. 1 plus pro rata interest rate. 1 plus pro rata interest rate. Now, what is the interest rate? 4%. What is the interest rate? 4%. Okay. 4% is per annum. 4% is per annum. Pro rata, it's for 90 days. Pro rata, it's for 90 days. So this makes it, rather than 0.986, which we were previously copying, 0.00986. Okay. Okay. 100,000 divided by, this makes it 99023. So please copy this. Yes, recording will be available. I will share the recording on the group. I have told this multiple times. Please wait, and it will be shared by evening because it takes time to get ready. And I have already shared the question file in the group as well. There are so many messages, and the problem is not with messages. The problem is that things have been discussed multiple times before, already told, and still you people are asking this again and again. The PDF file has been shared in the group. If anyone would please reshare it on the group again, and recording will be shared later. Obviously, it takes time to get ready. And Hazik, I don't know what's the problem with you, because the WhatsApp group link has also been shared 3 times in this group, and you are saying you are not in the group. So again, I'm sharing it for you. He has just joined the group. So Sapana, if you can share it again, please, in the group. Please share the file again in the group, and please don't ask for file again and again. It's been 5 or 6 times it has been shared, and this is creating a bit of disturbance again and again. Because at the start of the session, I requested multiple times to please join the WhatsApp group. You people didn't join that. I told you that I will share the files. Okay. Now, I just want to, for your knowledge, gather one thing. So let me just open that. Match the characteristics below with an appropriate working capital strategy. Match the characteristics below with an appropriate working capital strategy. High level of current assets, conservative investment strategy. Low level of current assets, aggressive investment strategy. Large amount of short-term finance, aggressive financing strategy. Small amount of short-term finance, conservative finance strategy. You have to match the characteristic below with appropriate working capital strategy. Okay. Now, in working capital, you have studied 3 strategies: conservative, aggressive, moderate, and you have studied this in 2 directions. Conservative, aggressive, and moderate investment strategy, which talks about investment in assets, and conservative, aggressive, and moderate financing strategy, which talks about financing. Okay. Now, if you know about aggressive strategy, aggressive financing strategy wants to raise finance from short term, and conservative wants to raise finance through long term. So large amount of short-term finance. Short-term finance is preferred. This will be aggressive financing strategy. And small amount of short-term finance. Small amount of short-term finance means large amounts of long-term finance. Long-term finance is conservative financing strategy. There are 3 financing strategies: conservative, aggressive, and moderate. So aggressive financing strategy says you should take finance from short term, and conservative says take from long term. Okay. So if you talk about large amount of short-term finance in large amount, aggressive. Short-term finance in small amount, that means long-term finance in large amounts, that is conservative. Talk about investment strategies. Low level of current assets, keeping very, very low level of current assets, keeping low inventories, low receivables, low cash, low investment in current assets, it's aggressive thing. High level of conservative current assets, inventory, keeping high level, that's safe, conservative. So all options have been matched with their respective things. Okay. Next question. Example 4. A company has announced that it will pay an annual dividend equal to 55% of earnings, and its earning per share is 0.8. So EPS, earnings per share, is 0.8, and company has announced it will pay a dividend equal to 55% of earnings. So the dividend per share is 55% of earnings. So 55% of 0.8. 0.44. Okay. A company has announced it will pay a dividend of 55% of earnings. Earning per share is 0.8. So earning per share is 0.8. Dividend is 55% of earnings, 0.44. Return on equity, ROE, it's 20. And current cum dividend share price is 4.6. Cum dividend share price. You are not given X dividend, you are given cum dividend here. Cum dividend share price 4.6. What is the cost of equity? Cost of equity is K. It's asking cost of equity is K. Now remember, if we talk about cost of equity K, it's two models we have studied in financial management to find K. One is DVM, one is CAPM. Okay. Does this thing, the data provided, suits CAPM? No, it suits DVM. Why it suits DVM? Because in CAPM you need RF, RM, beta equity. That's not given. That's why K would be found through DVM. And in DVM, the formula of K is D1 P naught plus G. The formula of K under DVM, it's D1 over P naught plus G. Now, if I see in this question, I am unable to find G growth rate. If I see in this question, I'm unable to find growth rate G. So how to find G? Again, there are two models to find G. Gordon's retention and past dividend. In past dividend model, you need to have the histories of dividends. That is not available. You cannot use that. But for Gordon's retention model, G is B into R, a retention ratio into ROE, retention ratio into ROE. You cannot apply past dividend model for growth. Why past dividend model cannot be applied? Because histories of dividend is not given. So you can find through Gordon's retention, B into R, return on equity into retention ratio. Now, return on equity is 20%, it's given. Return on equity is 20%, that's given. Retention ratio. Now, you might have studied dividend per share over earnings per share gives you payout ratio. Dividend per share over earnings per share gives you payout ratio. Now, if company's dividend per share is 0.44 and its earnings per share is 0.8. 0.44 is the dividend per share and your earnings were 0.8. That means you paid out 0.44 from your earnings of 0.8. Your payout ratio is 55%. Now, if payout ratio is 55%, retention ratio is 45%. If you paid out 55%, you retain 45%. So 45% is the retention ratio into ROE. Growth rate is 9%. Growth rate 9%, you can put here P naught. P naught is the share price X dividend. You are not given share price X dividend, you are given share price cum dividend 4.6. You cannot use cum dividend in this formula, you can use X dividend. So remove dividend from this cum dividend share price. What is the dividend? 0.44. Remove 0.44 from the share price cum dividend, you will get X dividend 4.16. Okay. Lastly, D1. D1 is the next year's dividend. Now, what is today's dividend? 0.44. You need next year's dividend. What is the growth rate? 9%. So if you increase the current dividend by 9%, you will get the next year's dividend 0.4796 divided by 4.16 plus 0.09. This makes it 20.5%. Okay, please copy this. If you have any questions, please ask. Yes, you can directly get it. No worries. Ayaz, anyways, you have to find 0.44 because unless you know the dividend, you cannot get the next year's dividend. So it states companies announcing dividend of 55% of earnings. So 55% of earning means 55% of the EPS. Okay, now if you have any questions regarding the 4 MCQs, you can ask. Now we will be doing one MTQ, and this MTQ will have 5 requirements, so we will solve them step by step. You all know that business valuation and risk management are likely to get tested in MTQs. So I'm doing one MTQ. This is also an examination MTQ from business valuation, so you can get a good command on this. Okay. The question states, obviously for MTQ, you have a proper case. Following information relates to Davzin company on a large stock market. Okay, its information is for Davzin companies listed on a large stock market. Revenue 35.5 million, cost of sales 20 million, other expenses 8.4, finance cost 1.4. Deducting all costs from revenues gets taxable profit PBT. Taxes 30%, this is PAT. Okay, following information relates to Davzin. Revenues given, cost of sales, other expenses, finance cost PBT, taxes given PAT. Equity and liabilities. Ordinary share capital is 26 million, preference share capital 10 million, retained earnings 21.5. This gives total equity. Non-current liabilities of long-term borrowings 18 million. Current liabilities of payables 11.1. You get total liabilities 29.1 and total equity liabilities. Okay. So just quickly recap the stuff provided. You are given a P&L extract, revenue, cost of sales, other expenses, finance cost, PBT, tax, and PAT. Equity liabilities, it's share capital, ordinary preference, return earnings, equity, non-current liabilities, long-term borrowings, current liabilities, payables, total liabilities, total equity liabilities. The preference share capital consists of 6% irredeemable preference shares at a nominal value of 0.5 per share, and cost of preference share is 8%. Remember, cost of preference share is called KP in WACC. Remember, the preference share capital consists of 6% irredeemable preference shares at a nominal value of 0.5 per share. Cost of preference share is 8%. Cost of preference share is KP 8%. Ordinary shares have a nominal value of 1 per share. Ordinary shares have a nominal value of 1 per share. Just for an idea, if 26 million is the ordinary share capital, 26 million is the ordinary share capital, and price of ordinary share nominal value is 1, that means company has 26 million ordinary shares. Just for an idea, that if ordinary share capital is 26 million, 1 rupee par value, that means 26 million shares. Company has a P ratio of 12 times. Stock market is expected to grow by 6% per year. Stock market price is growing by 6% per year. Long-term borrowing consists of 7.5% convertible loan notes at a nominal value of 100. Sorry, $100. Long-term borrowing consists of 7.5% convertible loan notes at a nominal value of 100 per loan note. At the end of 6 years, they can be converted into 40 ordinary shares or redeemed at nominal value. The before tax cost of that is 6%. This is the information. Now, I have been provided information regarding sort of P&L, profit and loss account, revenue, cost of sales, PBT, finance cost, etc. And I have been provided information regarding a balance sheet, non-current liabilities, current liabilities, payables, etc. Then information about preference share is given, then ordinary shares, and then long-term borrowings. Question number 1, what is the market value of preference shares of Daxwin company? What is the market value of preference shares of that? Now, market value of preference shares is required. The question is asking a market value of preference shares. Now, if you know market value of preference shares, how to get the market values of preference shares? How to get the market value of preference shares? Now, if you remember something about WACC, in WACC you studied the formula of cost of preference shares KP was PD, preference dividend per share over P naught market price of preference shares. Okay, you find KP in WACC, it's preference dividend per share PD, preference dividend per share over P naught market price of preference share. Now, question is asking you this market price of preference share. So what you can do is you can rearrange it. Market price of preference shares goes here and KP goes down. So for P naught market price of preference shares, it will be PD, preference dividend per share over KP. For this KP, it was PD over P naught, preference dividend per share over market price of preference share. We rearrange it. Market price of preference share is found. Rearrange KP in denominator, PD over KP. So let's find P naught. KP. Remember in question, cost of preference share above is given 8%. Remember, cost of preference shares KP is given 8%. Cost of preference share KP is given 8%. PD is the preference dividend per share. Now, what is the preference dividend per share? What is the preference dividend per share? Preference share consists of 6% preference share. The preference dividend per share is 6%. What is the preference dividend per share? PD. Preference dividend is 6%. Of what? Interest and dividend are always paid at par. So 6% of par value 0.5. 6% of par value 0.5 makes it 0.03 preference dividend per share. 0.03 divided by 0.08, it's 0.375. 20 minutes. People might be wondering that the answer is 0.375 and sir is taking 3.75 million. So just they again not become over smart. I will let them know that P naught is 0.375. I have taken PD, preference dividend per share, 0.03 over 8%. Since I've taken preference dividend per share, 6% of 0.5. 0.5 was per share, right? 0.5 was per share. So since I have taken per share, the value is also per share. It's asking market value of preference shares. So if you can go in the question. There are in the question, $10 million is the preference share capital and 0.5 is the nominal value. So 10 million preference share capital, 0.5 nominal value, 20 million preference shares. So 0.375 is per share and it's asking total. So 20 million shares. This will make total value of 7.5 million. Just recorrect it. I'm sorry. That 0.375 is the preference dividend per share, and you have 20 million preference shares. So 7.5 million will be the price. Any questions in this, you can please ask. Okay. Okay, it's just a joke now that how difficult you people make lives for a tutor. Remember a few minutes back, I said that there was one student who was saying we are going too slow. Just a joke, don't take it seriously. Now I've got two messages. Sir, this question, it was too fast. Please slow your speed. Now, what should I do? I don't understand. Reduce the pace. Some people want fast. Increase the pace. Some people want slow. So please pay attention. Whatever is the tutor speed, please follow. Because the thing is that you always have the recordings later. So even if something is very fast, you can always get back to the recording and see them. Okay. Now, next question. Using the PE ratio method, what is the value of Desmond? Now, if you have studied in business valuation PE ratio method, using PE ratio method, what is the value of Desmond? In PE ratio method, value is PE ratio into EPS. P ratio into EPS. Value is P ratio into EPS. Okay, now P ratio, if you go in the question, it's 12 times. P ratio is given, it's 12 times. See, P ratio of 12 times into EPS. Now we all know the formula of EPS. EPS is PAT for less preference dividend divided by number of ordinary shares. And I've told you number of ordinary shares, it's 26 million shares, 26 million, one par value. So let's move forward. P ratio into EPS. P ratio is 12 times. EPS is PAT 4 million minus preference dividend. Preference dividend is 6% of par value, 10 million. 0.6 divided by number of ordinary shares, 26 million shares. So 12 multiplied by EPS, 4 less 0.6, 3.4 divided by number of ordinary shares, 26 million. It's 0.1307. So this makes value as 1.569. There is no option here, don't worry. 1.569 is the value per share because you multiplied it with EPS, earning per share. So if you multiplied it with earning per share, you will get the value per share. Okay, this is earnings per share, value per share. You need total value, so multiplied by the number of shares. The number of ordinary shares are 26 million shares, just multiply it, 40 point. Okay, please copy this as well. Okay, so Hamza, whatever EPS is given, we have to believe that is the EPS relevant for us. Okay, now, yes, Hamza, you can do this as well. Based on the current ordinary share price of 2 per share, based on the current ordinary share price of 2 per share, what is the market value of convertible debt? Market value of convertible debt. Now, the definition of market value of debt is present value of outflows. That is interest plus redemption or conversion discounted at KD. This is the definition of market value of debt if I refer to Kaplan.
अगर अपनी कंपनी की वैल्यू अर्निंग यील्ड मेथड यानी कि पैट डिवाइड बाय अर्निंग यील्ड इज इक्वल्स टू 1/P रेशो, तो क्या उससे पॉसिबल है?
Junaid, I would advise you to please share your questions on the chats, not on WhatsApp. Okay, now the book definition of market value of convertible debt is present value of outflows, interest plus redemption or conversion, discounted at KD. Okay, now this debt is not just being redeemed, not just being converted. We have two choices. So first we have to check which choice is better. It can be redeemed after 6 years at nominal value 100. Okay. And it can be converted after 6 years into 40 shares. Shares have a current price of 2, but it will be converted into 40 shares after 6 years. Share price is growing by 6% per annum. So it will increase by 6% per annum for 6 years. So after 6 years, this is likely to become 2.83 per share, growing by 6% per annum. So 6% each year, 1 year, 2 year, 3 year, 4 year, 5 year, 6 years, becomes 2.83 per share and gets converted into 40 shares. Gets converted into 40 shares. So this will make it, I think, 113.48. This will make it 113.48. So if you just check it, that if we are redeeming at par after 6 years, that's what you used to do, right? It's giving us 100. But if we convert it after 6 years into 40 shares, each share is currently valued at 2, growing by 6% each year. So 6 times 2.83 per share. This makes 113.48. So what is the better option? Conversion. The better option is conversion. Now just find the market value of debt. Once you know that the better option is conversion, it's the present value of two outflows, interest plus redemption or conversion, discounted at KD. Now, this is redeeming after 6 years or converting after 6 years. So 1 to 5 and 6, two outflows, interest and redemption or conversion. Okay. So what is the interest? %7.5 interest on par value 100. Interest is always on par value. 7.5 is the interest, and cost of debt KD is 6%. So since it's being converted after 6 years, so for 6 years it will be interest. 7.5% of nominal value 100. So interest for 6 years would be 7.5. And after 6 years, it won't be redeemed at 100, it will be converted into 40 shares at 2.83 per share, 113.48. So these will be the two outflows, interest and redemption. 7.5 120.98. Okay, discount factor is KD 6%. KD 6%. So for 6%, you need factors of 5 years annuity and 6 years separately. So 6% for 6 year go in the table. 6% for 6 years. 6th year, 0.705. And 1 to 5 annuity at 6%. You have to go in annuity table. 1 to 5 for 6 years at 6%. 4.212. Net cash flows into discount factors gives you present value. $31.59 and 120.98 into 0.705, 85.29. You add up total present value of these two outflows, interest and redemption or conversion, 116.88. This is the present value of these two outflows, interest and redemption or conversion. This present value of outflows is the market value of debt, 116.88. That means bonds are trading at 1168.88 by 100. This is the market value. Now again, you go, there is no option 1168 by 100. It's asking for total. Now, if you go in the question, the balance sheet value of the debt, it's 18 million. The balance sheet value of the debt is 18 million. So 18 million is the balance sheet value. And bonds are trading at 1168.8 per bond because you took interest on one bond, redemption and conversion of one bond. So you get one bond. 18 million is the total value, trading at 116.88 by 100. So converting into total 21.03 answers. Any questions, please ask. No, Talha, in market value of bond, everything is before tax. Okay. And Junaid, I don't know your formula would produce the same answer or not, but if it's producing the same answer, then it's fine. Okay. Interest won't be after tax because market value of bond is computed on a before tax basis. So Junaid, if it is getting the incorrect answer, that means it's wrong. Simple. Akash, it's basically 2 per share. Currently, share price is 2 per share, and you will get 40 shares after 6 years. So it's increasing by 6% per year. So you needed to increase by 6% each year to get share price after 6 years, 2.83. Then we will get 40 shares. Okay, now there are last 2 questions in this MCQ. We will do that. Question number 4, in relation to information requirements for valuing shares, which of the following statements is correct? Again, the question is asking which of the following statements is correct. Again, the question is asking which of the following statements is correct. Now, if the question asks you which of the following statement is correct, I told you before at the start of this session that either you directly get the correct answer or you remove the obviously wrong options to reach the correct, both of them is fine. Only information on the market values of tangible assets should be used in valuing shares. It's asking which of the statement is correct. The first statement, only information on the market values of tangible assets should be used in valuing shares. We should only use tangible assets in valuing shares. This is wrong. In valuing shares, we include intangibles as well, goodwill, etc. So information on market values of tangible assets should be included. This is wrong. Okay. Shares are likely to be mispriced where managers and investors have different levels of information. Okay, this seems correct that shares are likely to be mispriced, wrongly priced, where managers and investors have different level of information. Like managers think company is going to end and investors think, oh, it's going to grow. Prices are likely to be mispriced. Let's hold it, move forward. Details of key personnel are not relevant to market capitalization of the listed company. Wrong. Details of key personnel are relevant. You know that when some key personnel leave the company, the prices falls. So details of key personnel are always relevant in market valuation of shares. Okay. Since companies do not release information that undermines their competitive advantage, most of the published information about companies is not relevant to placing a value of shares. This is also wrong. That published information is not relevant to placing a value on shares. You find value on the basis of published information. Every method you use, PE ratio method, it uses PAT, EPS, net assets valuation method, it uses assets, balance sheet, dividend valuation model, it uses dividend, assets, dividends, profits, are all published information. So you value company based on published information. This option is saying published information about a company is not relevant in finding value. Published information is the only relevant thing in finding value. This is also wrong. So correct answer is B. Shares are likely to be mispriced when managers and investors have different level of information. Even if managers think company is going to go up, but investors think it's going to go down, the prices will be different. They're likely to be mispriced. First point is stating that only tangible assets should be included in valuing shares. This is wrong. Intangible assets should also be included in valuing shares. Because when key personnel leave, the prices falls. There's a current case on TRG, the resource group affinity. The key shareholder, key personnel got removed from the board of directors due to a scandal. The prices fell. Okay, last question. In relation to behavioral finance, which of the following statements are correct? When investors believe that recent share price increase will continue, this can lead to irrational investment decision by uninformed investors. Irrational decision is typically a hodgepodge, wrong decision. Let's buy more. Irrational decision is basically a hodgepodge decision. Let's buy more. So when investors believe that recent share price increases will continue, they think that the price rise will continue. Do sometimes they take wrong decision and get stuck in that share? Yes, because whenever people feel that share price trend of increment will continue, they buy more without looking at fundamentals, because without looking at anything else, just buy more because share price increasing. So when investors believe that share price increase will continue, this leads to irrational, wrong investment decision. This statement is true. Second, informed investors can contribute to speculative bubbles. Who are informed investors? Informed investors are those who have insider information. Do people, those who have insider information, they create bubbles in share price? Yes, because insider news people, they tend to buy more, create demand, which increases share price, and it's a bubble created, which is sometimes going to burst. So informed people who have inside information, they create bubbles in the market, artificial increment in the prices. This is also true. So both 1 and 2 are true. Okay. So I think we started late. Approximately 2:20 p.m. Pakistan time, and it exactly took 1.5 hours to complete all these questions. Okay, please don't rely only on this video. I have told you in the initial that there are 4 more videos which I will share on your WhatsApp group. Okay, I will be finally sharing the WhatsApp group once for the last time. So please, everybody who has not joined that group, I would advise them to join this group. I will share the 4 previous videos as well there. And plus we can discuss some other issues there as well. Okay, use these 5 videos, this one and the 4 one. You will easily find some MCQs, maybe luckily more than 2 or 3 in the exam. Okay, take care. Bye bye.